All right, let's dive right in. Today, we're talking about a huge split that's happening in the global economy. It's really a story of one country that seems to be marching to the beat of its own drum, while a lot of others are struggling to keep up.
So here's the big question we're tackling. Is the US economy playing a totally different game from everyone else? While most of the world's economies seem to be moving together, the United States looks like an outlier. And the data? Well, it's pointing to a really sharp split happening right now. We're going to unpack what that means.
So where do we start looking for clues? Our first stop is a place that might sound a little complex, but it actually tells a very simple story: the global bond market. This is basically where countries borrow money, and it's a fantastic way to see how confident investors are feeling about different economies.
Okay, so what are we looking at here? Well, for almost every major economy, Japan, Germany, you name it, their borrowing costs, or what we call bond yields, are going up. That's what those positive numbers mean. Investors are getting a little nervous, right? They're demanding higher interest because of things like inflation or debt. But then, you look at the bottom. In the United States, it's the complete opposite.
Let's really put this in perspective. The average borrowing cost for other major countries has climbed by about 20 basis points. But in the US, borrowing costs have dropped by 48 basis points. That isn't a small difference, that is a massive signal. It's telling us that while investors are getting worried about the rest of the world, they see the US as a safe place to put their money. They're literally rushing to lend to the US.
So the bond market is screaming that global investors have this unique confidence in the US. The big question, though, is whether that confidence is actually justified. Let's pop the hood on the US economy and see if the engine is really running as smoothly as everyone seems to think.
And this quote just hits the nail on the head. Earlier this year, there was all this chatter about America's credit and rising inflation. But it turns out those fears were, they were misplaced. Those worries were very real for other countries, but the US has been telling a totally different story.
Now, to really put this confidence to the ultimate test, we have to look at the riskiest part of the market. This is what you'd call the financial world's canary in the coal mine. We need to see if it's signaling any danger up ahead.
So what is this canary? Well, it's something called CCC-rated bonds. These are basically loans to companies that are, let's say, on shaky ground financially. If a recession is coming, these are the first dominoes to show signs of wobbling. The extra interest investors demand to hold these things is like a super-sensitive fear gauge for the economy.
So, is our little canary chirping nervously? Nope, not at all. The risk premium right now is just 8.9%. And that's not just low, it's way below the long-term average of 11%. To give you some context, just before the 2001 recession, this number was over 20%. So today, investors are remarkably calm.
The takeaway here is crystal clear. The part of the market that's supposed to be screaming danger if a downturn is coming is pretty quiet, actually. It's a huge vote of confidence from the investors who have the most to lose.
Okay, so the financial markets are feeling pretty good. But is this just optimism, or is it built on something real? Let's check out if companies are actually delivering the profits to justify all this confidence.
And the answer is a huge yes. Just look at this comeback story for the S&P 500. After a little dip, what some called an earnings recession at the end of last year, corporate profits didn't just bounce back, they rocketed up. We saw growth hit over 10%, and then it accelerated even more from there. This is the real, fundamental strength that gets markets excited.
Now, it's super tempting to think, oh, this is just a few giant tech companies doing all the work. But the data shows something else entirely. Yeah, tech is on fire, for sure. But look at these other sectors. Materials, even old-school industrials, are projecting fantastic double-digit growth. This isn't a narrow boom. This is broad-based economic strength.
And that brings us to our final, and maybe the most dramatic point of all. Because nowhere is this great divergence clearer than in the tech sector, especially when you put the two titans, the USA and China, side by side.
This timeline shows you the exact fork in the road. Back in late 2020, Chinese tech looked unstoppable. Then, February 2021, Beijing unleashes this massive regulatory crackdown. And from that one moment, the paths of US and Chinese tech just split and went in completely opposite directions. I mean, just look at these numbers. They are absolutely staggering. Since that split, if you'd put your money in a fund tracking China's big internet companies, you would have lost 63% of it. Ouch. In that exact same period, an investment in the US NASDAQ 100 would be up 85%. The performance gap is almost hard to wrap your head around.
So what on earth happened? Well, it really comes down to two totally different philosophies on innovation. You've got the US model, which generally lets companies grow into these global giants with a relatively hands-off approach from regulators. And then you have the Chinese model, which puts the government's agenda first, leading to these sudden, unpredictable crackdowns that have absolutely spooked investors.
And when you zoom out and look at the long-term result of these two different paths, you see that they've created two completely different worlds for anyone trying to invest their money.
Over the last decade, the U.S. NASDAQ 100 has delivered an incredible total return of over 477%. It's just been an unbelievable engine for creating wealth.
And the China Internet ETF? Just 16.1% over a whole decade. That isn't just a divergence. That is a completely different investment universe.
Okay, so we've looked at bonds, corporate profits, this insane tech divide. What's the big takeaway from all this? Why does it even matter?
Let's just run through the story so far real quick. We saw unmatched investor confidence in U.S. bonds. We saw the economy's biggest warning signs flashing green, not red. We saw corporate profits that are strong and getting even stronger across the board. And finally, we saw how the American approach to innovation has just blown its biggest competitor out of the water.
At the end of the day, this quote really sums it all up. The results from the last decade, they speak for themselves. One approach to innovation has been way more successful for investors.
And that leaves us with the final and most important question. The case for American economic outperformance over the last 10 years is, well, it's pretty overwhelming. But we all know the world is changing fast. So the question we want to leave you with is this. The American playbook won the last decade, decisively, but will it win the next?